The opportunity.
Wow, what a turnout. Hello, welcome everybody. It's great to see everybody. This is a fantastic turnout, and I'm gonna let Chris Shefflin kick this whole thing off.
Sounds good. Thanks, Victor. Kate, how are we doing on numbers? Should we give it another 30 seconds or we have a pretty much majority?
I think we're good. I think we have critical mass.
All right, sounds good. Good afternoon, everybody. Thank you for taking the time to join us for this first Springboard Series event across our region. My name is Chris Shefflin, Mainlight Strategies. I'm going to quickly cover a few pieces of information as we set up this afternoon's program. First, this Speaker Series program comes out of the community design process for regional ecosystem building that many of you have participated in over the last few years. Today, like everything we do under the Springboard name, it is meant to serve you and belong to you, the entrepreneurial community. We anticipate doing about 3 to 4 of these events a year. After today, we believe the next Speaker Series event will be in September, looking at the 25th of September at the Swan Street Diner in Buffalo's Larkin District. That discussion will be focused on venture capital and hopefully include multiple VCs for that. So more to come on that soon. A couple other notes. If you think of others who'd be interested to participate in things like this afternoon going forward, please leave a note on the Springboard website or send an email directly to me. I'm going to have some contact information in the chat box in just a few moments. And one other piece, the application period for the Springboard Prize Competition is currently open and will remain open through June 10th. Many of you will know that from last year. We are awarding at least $500,000 in total prizes to successful applicants focused on entrepreneurial activities, networking, and events, looking to grow and expand our ecosystem. So please consider applying or sharing that application with others. I think you heard it as you came into the meeting, but please note that we are recording this conversation simply so we can make it more widely available after today's session. And I think that's the housekeeping. It's now my pleasure to introduce Victor Hwang. Victor is the founder and CEO of Victor & Company, which is an economic growth consultancy. He's also the CEO of Right to Start, which is the national not-for-profit that works to expand entrepreneurial opportunity for all. Many of you know Victor, along with his team, Kate McCurry and Mark Newberg. They have been deeply engaged in this ecosystem community design process. That process in Springboard overall has been strongly supported by the Ralph C. Wilson Jr. Foundation. So we say thanks to the foundation for initiatives like today and for all they do for our community every day. I'm now going to turn it back over to Victor, who's going to introduce today's featured guest, Ray Leach.
Thank you, Chris, and thank you all for this tremendous turnout for our guest today. I've known Ray for many years now, and Ray has has been a giant in entrepreneurship ecosystem building before it was even called ecosystem building. Ray was the founding CEO of a group called Jumpstart, and Jumpstart in Cleveland really became a model for how organizations could really lead the transformation and growth of their entrepreneurial ecosystems and economies. Within the last few years, Ray has embarked on a brand new effort, a very ambitious effort, in partnership with his partner Mark Kwame and a group of other leaders to create the O.H.I.O Fund. And the O.H.I.O Fund is, I'd say, one of the most pioneering, most innovative fund models that's being attempted right now, not just in the United States, but maybe around the world. It's been inspired by what's happening in other parts of the world and filling a gap that they saw in the O.H.I.O economy. But it really is a unique role. And so I'm very, very pleased to welcome Ray to join us, and we'll talk. I'll be doing this as a fireside chat, and then we'll open it up for questions as we go. And Ray, thank you, and thank you for joining us here today.
It's a pleasure to be here. I have huge respect for, of course, Victor and everybody on the call that's working on entrepreneurial ecosystems. It's something I continue to work on, but I spent 80 hours a week on for 20 years at Jumpstart. So I have a huge appreciation for the challenges of the work.
It's hard work, and it's a lot of sweat and blood and tears that goes into this stuff. So we appreciate that. But this transition is sort of a really interesting moment, I think. Maybe just talk about this, which is sort of how your story led to this moment, Ray. I think,
Sure.
given your work in almost 2 decades at Jumpstart, what led to sort of a transition point where you realized there's an opportunity and maybe even need to do something even bigger?
Sure. So maybe for a little bit of context, just for the participants today. So my career, right out of college, I went to work for IBM for a short time, and then at 22, from 22 to 38, I started and sold 4 companies in the tech space, and then spent a little time at MIT and at HBS during the dot-com crash and Enron and 9/11, and found myself going back to Ohio, which I did not have a plan to do when I was a Sloan Fellow at MIT, but given what happened in the economy. So when I got back to Ohio, through a series of happenstance, I had never done anything in the nonprofit world or the economic development world. I ended up being asked by a bunch of business leaders in Cleveland to launch a new kind of organization. Now you'd call, well, even then we called it a venture development organization, half venture capital, with the goals and objectives of economic development outcomes. And so I launched this new 501(c)(3), which actually was a merger of 5 entities that were kind of struggling to create Jumpstart. And for the last 19 years, or from 2004 to the end of 2023, I launched that business, launched that operation. Originally, Jumpstart was very focused on seed stage tech investing. So it was a 501(c)(3) that was investing anywhere from $500,000 to $1 million in 8 to 15 companies a year in Ohio. And I was able to do that in part because we were able to raise a lot of philanthropy, but also because of a state program called the Ohio Third Frontier. And that was in the very early days. The Third Frontier still exists. But Jumpstart ended up being a very successful investor, and seed stage companies generated a lot of returns. And from those returns, we not only invested more and launched for-profit 2 and 20 funds, but also did a lot of work in the small business space. So Jumpstart morphed from being kind of a pre-Techstars, pre-YC kind of model to more of a venture capital firm, but also a service organization that would coach a couple thousand entrepreneurs a year for free. Served as an intermediary for a bunch of state and federal grants, and then also had this venture capital wing, and that was catalyzed by the returns that Jumpstart, or now what's called Jumpstart Ventures, generated.
Well, a key point to mention there is that you were country before country was cool. Like you were doing, tech.
Yeah.
Basically, the incubating and accelerating has been something that's been there long
Yeah.
before it became popular, right?
Oh yeah, yeah, and heck, it was there, in the '90s, '80s, and '90s too. I didn't know it was there. I learned that in the early aughts, but it's obviously the whole ecosystem or the whole economy has scaled. But getting to your question now, Victor, why, how, and why did I find myself in the position that I'm in now? And I would basically. I'll get to what the Ohio Fund is, but pretty much I'd say the catalyst to this new thing has to do with gaps in the capital stack, or the absence of capital for all kinds of investment opportunities in Ohio. Like, and by the way, I was very involved in the founding of Launch New York. I was very involved with a bunch of things, the foundation, the Ralph P. Wilson Foundation. So I have history with all those things. So I would say, I have a real affinity for upstate and Western New York, the issues, the challenges, the history, similar to Northeast Ohio or Ohio in many ways. But, whether it's in early stage tech, whether it's in even things like private equity, or at least the kind of private equity investing we're doing, and in real estate, there's huge amounts of wealth in Ohio that is principally invested outside the state. And
Like
that's
in
true in
public equities and the bond market and
or venture capital.
or
So as an
VC even.
example, I mean, just downtown Cleveland, there's a couple $1 billion of LP capital in downtown Cleveland. Not a nickel of it is invested outside or in the Midwest. It's all in 5 states, all the whole 5 states that we all know. So even when there is wealth in your community that is investing in things that are parallel or that are relevant to what you're doing, that money is not being invested locally typically. It's certainly not being invested at scale. And that's because the managers that live in other parts of the country give you the greatest assurance for return. And it's quote unquote where the smart money is going. And so when and of course, if you've worked in economic development or venture development for 20 years, you know where all the bodies are buried, you know who buried them, you know what happened on all the projects that failed, you know all these things at the local context.
You
But
know their
what you
cousins
all
and their
right,
uncles and aunts
right,
all as
right,
well.
and their offspring and all that. But what you also know is, or what you have a better sense of, if we had the ability to aggregate capital to focus on this particular opportunity, um, it would make a huge difference. So that capital gap issue, and let me give one quick little anecdote, and then I'll go on to better, broader examples. So Jumpstart was a seed stage investor. So, we would invest anywhere from 250, or still is in many ways, 250 to a million in a company. And as we all know, that's like the dumbest money you could possibly find, right? Or in other words, it's taking the highest risk. So when you've got somebody investing the first 500,000 to $1 million in a three, four, 5 person company, you're taking a tremendous amount of risk. That's why you need to be able to do 10 to 15 a year, because you have no idea which of the three are going to work out of the 15. So it's a game of at bats. Well, in Ohio, and this was very true 20 plus years ago, but it's still true today. When the early money is all local money. When the companies start maturing and advancing, 95% of the money is non-local money. When the companies get de-risked, it's the non-local money that comes in to invest in the companies. And guess where all the profit goes? It goes back to California or to Boston or New York. So we have a system problem around aggregating capital that can invest in deals, that can generate returns and increase the strength and the velocity of the local flywheel. And I'll say local in a state or a large region. So I have tons of examples at Jumpstart, but the most prolific or the most provocative one is Jumpstart was the founding investor in Cover My Meds. We invested $500,000 into a business that returned 48 million to Jumpstart. We had an opportunity to invest 2 million later in the ecosystem and the evolution of Cover My Meds, and we didn't have the 2 million. If we did, it would have generated another 40 million for Jumpstart. So 2.5 million would have generated almost 100 million cash on cash returns. But guess what? No one else in Ohio had the money either. So there was a huge lost opportunity to have that capital and to deploy in that business at that time. So that's kind of one part. Now I'll kind of go to the evolution. So about 2 years ago, Mark Kwame, and Mark was a partner at Sequoia, moved to Ohio in 2011 to work for Governor Kasich. Mark's the founder, or was the founder, of a group called Jobs Ohio, which is one of the most prolific and interesting privatizations of economic development for a state. So basically, imagine your economic development entity in your state owns your liquor monopoly. So you're generating 600 to 700 million a year in revenue, about 350 to 400 million in profit. That's who Jobs Ohio is. Mark is who created Jobs Ohio. He left the state government after 2 years, and he was the co-founder of Drive Capital. And Drive is the largest venture capital fund in the middle 45 states. It has 2.2 billion under management. It's headquartered in Columbus, but it has offices in Denver and Chicago and Toronto and Atlanta. So it invests all across kind of the middle part of the country. So Mark Kwame called me one day 2 years ago and said he was thinking about leaving Drive. And Drive had just raised $1 billion of new capital. So the first thing I thought of, Mark, why in the world would you be leaving Drive? You just raised a bunch of additional money. And he shared that he had just turned 62. And he's like, I do not want to be chasing early stage tech founders when I'm in my 70s. I cannot envision myself doing that. So what I want to do is what I originally wanted to do when I came to Ohio, and that's to basically create a private sovereign wealth fund.
And maybe explain a bit now, because
Yeah,
the Ohio Fund, there's so many aspects of it that are very different from any other fund.
right, right,
It's a sovereign fund in the sense that it's meant to be permanent and evergreen. It's
correct,
also it works multi-asset classes. It
correct,
works across every stage of capital. It works across
right,
every type of capital, from real
Right.
estate to private equity to venture to alternatives.
Right. Right.
Uh, it's really a very, very different kind of approach.
Right.
And that's actually become a trend now. There's actually more and more evergreen funds. Sequoia was probably the most
Sure.
prominent example of it. But why does that matter? And why that kind of structure fits this particular
Yeah.
situation?
Yeah. Well, first, the inspiration, just so you could jot it down, is a fund called Temasek, Temasek, based in Singapore, 50 years old, started with 180 million of assets in 1974. Today it's worth minimum 400 billion. Some folks say it's worth 420 billion. Temasek's investing anywhere from 30 to 60 billion annually. And Temasek is so big, the country of Singapore is teeny tiny geographically. So, but it's 6 million people. And the size of the Singapore economy is half the size of the economy of the state of Ohio. So it's about a $550 billion economy. So what did Temasek get right? First, they pooled private capital, leveraged private capital, and they invested for return, but that investing could cut across the entire economy. It just had to be in Singapore, at least for the first 35 years. So what Mark and I are doing is we're basically raising a fund, 100% private capital. So there's no state money, even though it's called the Ohio Fund. There's no government money. There's no state money. There's no economic development money. That capital is being raised, at least so far, 100% from Ohio LPs, banks, hospitals, foundations, corporations, institutions, high net worth individuals, family offices. And the whole premise of the Ohio Fund is based on, we think the next 50 to 70 years will be the most prosperous years in the history of our state. We have very low taxes. We have 12 million population. 65% of the US economy is within an 8-hour drive of Ohio. We have all the water, all the energy we could possibly need. We're on the Great Lakes, but we also have a massive natural gas. The Utica Shale sits under Ohio. So we have all these assets in Ohio that we're ready to leverage and deploy. We have a ton of cheap land. We have a lot of flat land in Ohio, particularly in Northwest Ohio. So the idea is let's go raise 500 million to invest in Ohio. Raise 500 million from Ohioans to invest in Ohio all across the economy to get the flywheel going so that the wealth in Ohio has an opportunity to invest in a fund that's totally focused on Ohio. Number one. Number two, many of our investors are the largest real estate developers in Ohio, so they're bringing us their deals. They're bringing their deals to the fund, and our fund is investing, but then we're also bringing our investors to those deals. So a good simple example that's hot off the presses is last week we closed a deal with one of the most successful land aggregators in the country. It's called the New Albany Company. New Albany has recently, over the last couple of years, bought 2,400 acres of land in Central Ohio, which, by the way, Central Ohio is one of the fastest and most densely concentrated data center communities in the United States. So they own 2,400 acres of land. They had spent 270 million to acquire that land. Last week, we closed on a joint venture where the Ohio Fund bought 25% of that land from the New Albany Company in a joint venture partnership. And now together, and then that's 70 million. Half of that 70 million we also offered to our investors so they could go direct in half the deal, but the fund took the other half. And we're expecting we're going to generate a 4 to 5x return on that land in the next 30 months. So
It's
when you partner with local stakeholders, and by the way, one of the big lessons, if I had to do Jumpstart again, I would have started with a fund that's a multi-asset fund. All the wealth, huge amount of the wealth in Ohio was in real estate. I never spoke to anybody in real estate for 20 years. And by the way, they didn't want to speak to me either because I was the guy taking super high risks, investing in things that were way outside their comfort zone. So the Ohio Fund, in the near term, it's 500 million. Think of it as a third in real estate, a third in, I'll call it private equity, but a big difference in our strategy is we're not a majority investor. We do not want to control the company. We want to write a check of 10 to 15 million. of equity, fuel the growth of the company, be a minority owner, shareholder in the company, maybe get distributions, but we're not looking to buy a company to do a roll up and then ultimately have the thing headquartered in one of 6 states. So that's the PE piece. And then the final piece, actually, we're going to invest 5% of our money into seed funds and other funds that are complementary to our strategy. But then the remaining 25 to 30% is to make sure that the O.H.I.O fund is the lead investor in all B, C, and D tech deals in the state of Ohio. Because right now there isn't a lead investor in those deals unless you happen to be a dry portfolio company.
Now, you said if you could do Jumpstart again, you would do it as a multi-asset class fund. Now, that's contrary to, what half a century of venture investing and the way people have done that. And I'm curious about that because they're very different areas of expertise, right? Real estate investing versus venture. Why do you think it's worth diversifying in that way and going kind of doing something outside of what people are used to get
Yeah.
market rate, I
Well,
guess more access to market rate
yeah.
returns? Yeah.
If you want, so the simple answer is it's an incredibly compelling way to build trust in your community, in your state with people that have significant wealth. So what's the main reason why the wealth in your community does not invest in tech? It's because they don't trust the manager, the team, the track record, and the experience of that group. So if you now over the long run, the O.H.I.O fund will have other funds. I mean, this is just kind of the corpus fund, right? So this evergreen fund, but I do anticipate that this fund, the success of this fund is going to generate multiple types of different funds down the road. But literally in the last, I've raised, it took me 17 years to raise 100 million at Jumpstart for seed investing. I raised 100 million for our fund in 9 months, talking to basically the same people. What was different? This investment thesis had a much greater likelihood of generating returns. This investment thesis made sense to people that have made all their money either in more mature businesses that attract private equity or in real estate. Like, 98% of the wealth in Northeast Ohio was not 99.99999% of the wealth wasn't generated by a tech company. Right. So think about if this is around intermediate to long-term systems change. Me bashing my head against the wall, raising seed funds for 20 years, I wasted a lot of time. I could have gotten a lot further faster by starting at a different place.
It's like a bridge, right, in between people that maybe are used to making money off real estate or more predictable returns. And venture is it's like a 0 or 100 is sort of the venture model, right? And that's hard for people to swallow.
Right. And I come back to trust. So like, hey, I've raised a ton of money from real estate people now, and we're getting to know each other. And of course, we have people on our team that are expert in real estate that I'm not. So I'm not able to fake my way to being expert in real estate. I'm not even trying to do that. But if you can build a relationship with folks, the person who would never even take a meeting from me, if I can generate that person a 2, 3, 4x return in the next 2, 3 years on this multi-asset fund, I guarantee you I'm going to be able to convince that person to invest 5 million in a tech fund because they know me. They trust me. We have history together that I never had with them when I was at Jumpstart.
Yeah. And we're going to open it up to questions. If you got a question, either raise your hand virtually. You can hit the little button, or you can put it in the chat box and we'll call on you. But I'm curious about the decision not to take any public money, because Temasek, of course, was the Singaporean government sponsored that. But it's taken on, a huge life of its own.
Sure.
But in this case, you decided not to go after public money, and there certainly is a lot of public money going into these types of, economic development initiatives these days. Talk about that decision and why.
Well, we just felt like we could get further faster without taking the public money. It can be, I've raised, probably 400 million of public money over the last 20 years, so I know what it takes to be able to do that. And I've helped a lot of other organizations raise public money. We wanted this to be clean and simple for private investors to be able to get comfortable with right out of the box. And, hopefully you're not in the situation I was in, and that anytime I walked into a room, people viewed me very skeptically because I was the guy at the public trough constantly. I mean, what most private sector I mean, the reality is most private sector investors didn't even really know what Jumpstart did. All they knew is it was way too risky for what I want to do. So now, also, the reality is we either are or anticipating talking to pension funds. So it's not like we're not going to approach large pools of capital that are connected and or affiliated, indirectly with the public. We will do that, but we just didn't have enough of a track record to be able to, our fund's not even a year old. And in our first year, we'll have invested a little over 100 million. And we'll have SPVs of about 50 million.
Yeah. So we got a question now from Jim Sinal and Teresa Mazzullo, I guess together at the same time. Jim or Teresa, do you want to talk about this, which is the structuring of the fund and how you get your money out, which I know is really innovative the way you guys have done it, Ray?
So I don't know. Can I read the question? Or you
or Jim, Teresa, do you guys want to read it yourself? I see a Jim.
Sure. Yeah. Can you hear me okay?
Yep.
Yeah.
Can hear you.
Yeah. I'm not sure. Okay. So I 25 years ago tried to raise an evergreen fund, and the feedback I got from LPs that were institutional were like, we're used to the standard model where we're in and we get our money out and we decide to make the next one. So I'm curious how you convince them to stay in. Can they get out? Like, how do you structure that and convince them to do an evergreen fund?
Yeah. Okay. So first, the O.H.I.O fund is technically two funds that comprise the 500 million. Both of those funds invest in every deal whenever possible, but technically it's two funds. Why is it two funds? Because our first investments came from 8 banks, and it's illegal for a bank to invest in an evergreen fund. They're not allowed to invest in an evergreen. So we're closing the institutional impact fund right now, or the traditional closed fund. My guess is it'll be between 125 and 150 million. And we're doing the final close at the end of June. And the reason why we're closing it 1 year in is because we're going to have our first exit in the third quarter of this year. So the first deal we had in June, we're selling for what we anticipate to be a very significant return 15 months later. And by the way, that's 150 acres of land in central Ohio was that first investment. So, we've done nothing to that land other than own it. A whole lot easier than seed stage investing. That's for sure.
So how do people get out? Yeah. How do you, because you've structured the evergreen part kind of based on, you have to create some new mechanisms around that.
Yeah.
Right?
So on the closed fund, you get out when we have an exit, but on the evergreen fund, it's quite different. So on the evergreen fund, we're basically creating liquidity windows start on a quarterly basis, starting in year 4. So if you are an evergreen fund investor, that we're going to keep your money through the investment period, but then we are going to provide 4 times a year an opportunity for you to take your NAV, your net asset value of your account, and get into queue for liquidity. And we anticipate being able to generate 10 to 15% of liquidity annually out of that fund. So if you're someone who wants to have more control over when you get liquidity, the evergreen fund can have an advantage because you can obviously choose to just keep rolling, or you can get in queue, either way. But that's the mechanism. And of course, you could always sell your entire capital account anytime you want out of the evergreen fund, but you're doing that on a secondary market, at least in the near term. Ultimately, we plan to create a mechanism that would buy your capital account at NAV and whole. But in the near term, we're just creating this liquidity queue process on a quarterly basis.
And what's the feedback on that when you talk to some of the investors? I know this is kind of similar to the Sequoia model. Very positive.
It's been very, very positive.
They like that quarterly liquidity window.
Yeah.
Nice.
Now, we originally did not have this. So when we launched the fund a year ago, we had it as, hey, we're working on creating liquidity, but we don't have it yet. So we're actually updating the docs right now, and it's retroactive back to the beginning. And it's been a huge shot in the arm. So of the 225 million we'll have closed by the end of June, it's about 50-50. Half in the evergreen fund, half in the closed fund.
Uh, how do you make sure that there's not an over redemption? I guess you don't want, of course, people pulling everything out because you've got a lot of illiquid assets there too, right?
Yeah, well, we can, I mean, we're in control. So like we have the ability to throttle it back. Like we can, if somebody said, "Hey, I want out entirely," we say, "Well, it might take us 5 quarters to do that." They don't have the ability to exit lock, stock, and barrel, at their timeline. It's our timeline,
Got it. Question from Alex.
That's pretty typical.
Yeah. Alex, Killian, did you want to ask your question around timelines on investing through different asset classes?
Yeah, thanks, Victor. Ray, pleasure to connect. Yeah, just curious how that type of fund structure you balance kind of demand from a capital requirement at investment and then kind of liquidity timelines and how you're mirroring that up and the strategy around, return modeling. I think
Yeah.
super interesting. I'll just kind of caveat, like I actually think this is really well positioned because I think venture starts to move to look more like a REIT type investment where you have dividend like distributions as
Yeah.
companies raise less capital and are more efficient and get to profitability sooner.
Yeah, so our capital call process originally was we're calling it over 3 years. Now with this update to the Evergreen Fund, by the end of this year, we're just going to call it all. So whatever somebody now you could add to your capital account. So, let's say theoretically, if you were going to commit $1 million, the minimum for us is 500,000. So you've got to commit 500,000 in either one of the funds to get in. But after you do 500,000, you can add to your account, which obviously makes more sense on the Evergreen side than it does on the closed side. But originally it was a 3-year draw. Now we will raise another closed fund. So when we get through the investment period of 3 years, we plan on raising another closed fund, and we might have a series of closed funds. Unless we just raise so much money in the Evergreen Fund, we don't need to do that. On the return, we're basically targeting returns within 3 to 5 years. So, if we're investing in something for a direct check, we're not going to invest a ton of money into funds up to 25 million. I mean, those we might have returns for 10 years. But for the direct checks, we're really looking for things that could generate a return much more quickly than what a Series A fund would look for, let alone a seed. So that's why we're focused on B, C, and D, not A. If we want to do something in A, well, let's do it as an LP in a fund. Let's not do it as a direct check writer.
Yeah,
So
Endeavor's benefited from that for their nonprofit. It's not a nonprofit, it's a for-profit, but it's a nonprofit entity. Their Catalyst Fund out in New York City, they're taking advantage of coming in the later rounds and getting liquidity sooner. So
right.
great stuff. Appreciate it, Ray.
Yeah, question from Kathleen Burke about how the effect on local entrepreneurs from the capital. Kathleen, you want to ask that yourself?
Hi, how are you? Thanks. I was curious when you were mentioning, Ray, focusing on the local and how you have seen that local focus really shape the impact of this availability of local capital all of a sudden, and then, how that's shaped entrepreneurship in your region.
Well, we're only 8 months in, so, I don't know. I guess the initial reaction is people were ticked because we weren't focused on seed and Series A, which seed and Series A is a huge problem in our part of the country. And we do have every intention of having a large Series A fund that would manifest out of the O.H.I.O fund in the next 2 to 4 years. But the initial reaction, I think, was frustration that we're not investing 150 million in seed and Series A. The tech investing we are doing is in B, C, and D. Really, for all
Mm-hmm.
practical matters, it's really B rounds, and maybe some C rounds. I mean, maybe like Anduril. Yeah, it looks like there's a good chance we're going to get into the Anduril deal. I don't even know what round you'd call that, and obviously it's got a huge valuation. But so this is not a dramatic near-term boost in the arm to the entrepreneurial ecosystem. I do believe, though, over the next 5 to 10 years, it could transform your entrepreneurial ecosystem. Because if you build trust with these pools of capital, at least in a place like Northeast Ohio, I mean, the largest Series A venture fund that's ever existed in Cleveland was like probably was Jumpstart's last $50 million fund. It's not a very big fund. Um, Maybe Early Stage Partners was a little bit bigger in 2008, 2009, going back a ways. So and again, it's almost like you got to take a step backward, at least from the entrepreneurial ecosystem point of view, in order to dramatically go forward. And I never saw that in the seat, and with my hand on the steering wheel. I never saw that, and I very much regret not thinking that through, because I think, if you're going to invest 20 years into something, because I think when I walked off the field of Jumpstart, were things better? Yes. Were they dramatically better? I would say they weren't.
In some ways, I think of it like it's like a pipe, and if you can unclog the later parts of the pipe, the water will flow in the earlier parts of the pipe eventually. The water,
Right.
it's going to flow better. It's going to flow immediately in the later parts of the pipe faster, but the early parts of the pipe are dependent on the water flowing through the whole thing, right?
Another thing that I kind of skipped over, but I think is super compelling, and it would be for you guys too. Your economy is big enough where you can cherry pick deals in each of these areas with very, very seasoned experts in each of those areas and make a lot of money doing it. So the opportunity to invest across the economy dramatically enhances not just your deal flow, but the likelihood you're going to generate. I mean, we're promising a 20% IRR to our investors. There's an 8 to 10% hurdle. It's like GP gets nothing. If you've invested 500,000 to 24 million, it's an 8% hurdle. If someone's invested 25 million or more, and we have three of those folks, and then we're committing to a 10% hurdle. So it's a lot easier to generate that return if you're investing across the economy and getting to cherry pick things, as opposed to having a narrower geographic focus or a narrower asset class focus.
Jim Sinal has another question. I'm going to put up this one slide from your deck, Ray, about the structure, because I think this question is coming up a lot, and if that's
Sure.
all right, see
Sure.
if this I think is a very useful slide. You want to walk through this, Ray, and just sort of talk about the structure of these two funds that feed into the Ohio fund?
Yeah, just think of the one on the left as a traditional venture or private equity fund. It's a 10-year fund, two 1-year extensions, an 8% pref. So traditional pass through, it's a European waterfall. So we made an investment last June. We now get a 3x. You get your distribution in July. So it's very normal. Whereas on the high growth opportunities fund, that is more oriented for long-term investors who want to control liquidity and control when they, and obviously not just liquidity, but taxes. So in that structure, actually, and we are updating this, I'll send you a new slide. So the original high growth fund was taxed as a C Corp, and this is what we're updating. So we're updating this to a partnership. And the reason for that, there's multiple. As a C Corp, what's nice about a C Corp is that it's kind of clean from a tax point of view. You have to pay 21% taxes, but there's no flow through to the investors. We're going to allow people to stay in the C Corp if they want to stay in the C Corp, but there's actually some additional advantages to add a partnership structure to this. So it's going to be both. It's going to have the C Corp optionality and a partnership. But in either case, if you're in the C Corp, if you want your money to stay in the C Corp, we're just going to automatically pay C Corp taxes. If you want your money to go to the partnership, then it wouldn't be taxed like a C Corp, and you'd have even greater flexibility around, when you can draw down your capital and how it gets taxed to you as a pass-through entity, as opposed to a C Corp.
Well, so you'll have like three different entities. You'll
Right.
The one on the right will be a C Corp and a partnership, but I guess the
Correct.
partnership allows you to do like tax loss harvesting and things
Right.
like that.
Right. Exactly. And we do. The demand on the real estate side has been so high. I do anticipate we're going to raise a REIT in 2026. We will have a third fund or a third fund, I guess. Yeah, third fund that's 100% focused on real estate.
Mm-hmm.
And my guess is that'll be 100 to 200 million. just because the demand has been so overwhelming. And what's been neat about it is, since some of the largest real estate developers in the state are our investors, they're bringing us their deals and they're giving us their pricing. And the other big advantage we can bring to them is when our fund invests in a deal, then today we have, well, this deck, I think we said we had 55 investors. We're soon going to have 90 investors. So we can bring all 90 of those investors to that SPV. And a lot of those investors want to invest in the fund because then they can get access to proprietary deal flow they couldn't otherwise get access to.
Mm-hmm. Yep. I know I saw folks taking pictures of that and probably screen copying, but
Sure.
a question from Paul Reiser, speaking about the role of corporates, strategics. Paul, do you want to ask this?
Sure. Hey, good to see you, Ray. It's been a little
Hey,
while.
Paul.
Good
Yeah.
to see you. So yeah, I wanted to hear your feedback on the participation of corporates, both from not just capital in corporate engagement, but also the social capital as well, potentially, given that they stand to benefit as subject matter experts if they participate, that they on the other end of some of these companies that grow, they could actually be, brought in as solutions or, so, and then that as well as in various markets, you have unicorns who have done well in maybe the last 5, 10 years. And then there's always the challenge of keeping them engaged and how can you keep them that hungry appetite? Have you seen that with this opportunity as
Yeah.
well?
That's a great question. And, a lot of times when we talk about the fund now, I mean, in the early days, it was all smoke and mirrors, right? Because it was a new team. No one had ever done this before. What kind of deals are you going to do? So, it was an interesting early fundraising scenario. But now, a lot of times, what we end up talking about is basically we're creating a club. We're creating a club of corporations, foundations, institutions, high net worth individuals who want to be part of a club. And the purpose of the club is to make money, but the mechanisms to make money are to focus on investing on things in our state and to leverage each other's knowledge and proximity to deals. It's basically to scratch each other's back. Cincinnati Children's Hospital is a big investor in our fund. A big reason why they're a big investor in our fund is they have an incredible innovations team there, and they've really struggled to raise early stage capital for some of their innovations. And even though we're not an early stage fund, we're going to have 150, 200, 300 of our investors by the time we get to 500 million, and 20% of them invest in the early stage. So what they can do and what we're offering for free is we'll bring your deals to our membership. And if it fits our profile, we'll invest. But if it doesn't fit the profile, we'll still share it to all of our investors, and maybe they'll write a check directly. At the same time, you can, I would guess, I'm not a native of obviously upstate in Western New York, but in Ohio, I would say probably 80% of the business leaders in Cleveland, Columbus, or Cincinnati have little to no connection to each other. So if I'm an institution, a high net worth family, an entity in Cincinnati, I probably do no business with anyone in Cleveland. If I had the opportunity a half a dozen times a year to come together and to meet the folks, like we have events, we're getting ready to do a big event on real estate. And like we have some big builders that are investors in the fund. We also have a whole bunch of folks in the building supply chain, and we also have land developers. So the idea of bringing together folks from all across the state to share knowledge, share information, share relationships. And our goal is, whether we invest in the deal or not, for them to do business together. So I do think ultimately the human element, along with returns, is what's going to be the transformative attribute, the most important transformative asset attribute and capability of the fund. Because now all this money is disconnected from each other.
It really is. People want to be part of something, right? And you're giving
Right.
them a vehicle to do that.
Right.
What's been the hardest part of this, maybe that you didn't expect?
Um, Ohio's a pretty big state. There's been a lot of travel. I mean, corner to corner, it's not as big as New York, but corner to corner, it's 4 hours, 4.5 hours, like, Ashtabula to Cincinnati and vice versa. There's been a lot of chicken dinners, a lot of rice pilaf, a lot of pitches.
It's
Of course,
grueling.
we all know that, but I would say probably that's day to day, week to week. But I would say the fact that no one had ever done this before was probably the hardest. I mean, we're obviously anybody who's in the inventing business is very appreciative of proxies. Like if you can't point to anybody who's done it before, that's really, really hard. We could point to folks that had done it. Now, maybe it was someone like Tomasic. There are no basically private sovereign wealth funds in the United States today. There are sovereign funds, the Alaskan Permanent Fund, or there's a fund in New Mexico, but there's no one who's trying to do what we are trying to do yet. I'm sure that will change. I mean, we've already had 10 states leaders in 10 states reach out to us on this idea and concept. So I'm sure this is going to be a trend. But the fact that now we can talk about 16 deals that we've done in 10 months and who our partners are in those deals has made it much, much easier because now people can actually wrap their heads around what we say we're going to do, because we're doing it. So I think that the early selling was probably the hardest.
Mm. Did it help that firms like Sequoia, and I heard Hamilton Lane has recently created their own evergreen fund, and that there are more and more institutional funds turning into permanent
Sure.
evergreen models?
No,
Has that
yeah,
helped?
yeah. I think it has, but still 90 of the people we're talking to, I would say 90% of the people are generally unfamiliar with Evergreen. So you can point them to the market leaders that are doing it. And obviously, some of them are investing in those funds, but there's still education. And it is nice to have the optionality. It's like if you can't get comfortable with the Evergreen fund, you could go into the closed fund. That's been a nice thing to have. We're going to lose that in a couple months because we're not planning on raising another closed fund until next year at the earliest. So it'll be interesting to see, can we continue to get people or can we get people to commit to the Evergreen Fund, even though they're not guaranteed to get liquidity in the next 3 years?
Hmm.
That remains to be seen. I'll report back on that in like 3 months, 6 months.
What is you mentioned you would have done this at Jumpstart if you could have, but it seems like it would take a certain critical mass of capital and resources and talent across sort of different asset classes to pull that off. If someone was in Western New York trying to think about doing this, what's the minimum you would need in terms of dollar amount and sort of expertise across different asset classes or people? I mean, what would you need to really pull this thing off? It's hard to start from zero on something like this, right?
Yeah, yeah. I don't know. I think where I would start is, are there individuals, groups, funds that have a 10 plus year track record of generating returns in these different asset classes that are curious about collaborating? And then with that group, you could determine and discern what's a meaningful amount of capital. You know, what sticks in my head is like 100. You better be able to raise at least 100 million um, to be able to give this a real opportunity for liftoff. And then if you think about the different asset classes, I guarantee you there's an easy way to put 30 million into real estate. That's not going to be an issue. I bet there's some compelling opportunities to do it in PE. And then the question is there a smart way to invest 30 million in things that have been de-risked on the tech side in the next 2 to 4 years? My guess is there is, in a region like upstate and Western New York. So to me, 100 feels like kind of the bogey. Could you build a deck? Could you build a logic model that and obviously find partners, that are expert. Because, I think given Mark Kwame's reputation, my partner's reputation, I was able to um, overcome the perception of who I was and who I am. Because, people look at me, well, you're an early stage tech guy. What do you know about real estate? So, and in the first first 8 months, there was just Mark and I. It wasn't like we didn't have a real estate expert, but I think people believed me that we would hire someone that's expert when I said it. But so that having that credibility of the collective, I think could be important.
Hmm. And if anyone's got questions, again, feel free to raise your hand or put something in the chat. I'm curious about how I know Mark has had a real impact in the Ohio ecosystem. How can someone in Western New York sort of replicate that as best as they can? I mean, that seems like getting a Mark is a bit of a random, unpredictable thing. But how do you sort of leverage some of that momentum or access or track record that he was able to bring to this?
Yeah, it's kind of a fluke. The way that Mark and I ended up getting closer was during COVID, when business leaders in Cleveland decided they wanted to put up 75 to 100 million of LP capital to recruit a GP to Cleveland. So basically, it was kind of a similar construct to with Drive, it just happened organically. Mark decided to stay in Ohio, and he decided to launch a fund and recruited a partner from Sequoia, Chris Olson, to be his partner at Drive. So there really wasn't any bait in the water. And oh, by the way, of the 2.2 billion that Drive has raised, 10% has come from Ohio. The vast majority of that capital has not come from the Midwest or from Ohio. It's come from the coast. But Mark's reputation is what convinced the LPs to invest. So, the real question is, how can you identify a person whose reputation will motivate investors, whether they're local investors or non-local investors, to invest in something that is in your community? And that is a tough nut to crack.
Mm. Is that something that could be done by design, to look for partnerships with investors? And
Yeah, I think so. I mean, I absolutely think it can. That's what I was doing and basically I was able to convince conceptually. Well, they did agree. The entities in Cleveland agreed to invest 75 to 100 million twice, because they also knew that if they were able to convince a GP to relocate who has a great track record to Cleveland, they're not going to have any returns in 5 years from their first fund, because it's a Series A fund. So not only do you have to invest in the first fund, but you've got to invest in the second fund too. And the other premise was that this person could raise another 50 to 75 or more on their own. So you'd ultimately have 150 to 100 to $200 million fund headquartered in Cleveland. I do think having that capital, even if it doesn't invest a lot of the capital in your home market, I think that is one of the most important outcomes, if you're able to realize, is to have that capital locally. Now, of course, on the Ohio Fund, we're doing that differently. If the Ohio Fund ends up being really successful with this first $500 million fund, not only will we be able to convince Ohio investors to invest in tech, but we'll be able to recruit GPs to run those new funds that the Ohio Fund is creating that do have great track records, because we'll have a lot more capital. So it's like, what are the mechanisms to aggregate ever-growing pools of capital, whether they're permanent or temporary, is where I didn't focus enough of my time and attention on at Jumpstart.
Hmm. Well, I mean, and it's hard because you're having to work at so many levels at once, right? You have to think in terms of not just the craft of early stage investing, but also the meta movement of capital markets as a whole, which is like it's just it's a lot to have to work on all at the same time. How does any lessons for Western New York? I thought when we proposed having you be a speaker, it was that, Ohio's not that different in economic structure from Western New York and some history and geography. Just curious, what lessons would you provide for anyone that wants to do this?
Well, none of the things that have happened in Ohio could have happened without the state. And I mean, the state of Ohio, whether it's in the pre-seed and seed funds or in the what's called the ESP, the Entrepreneurial Service Provider Network, which has different leading groups across the state. I mean, the state has poured at this point, I don't know, it's got to be probably 600 to 700 million into that ecosystem over the last 20 years. And without, I wonder where Ohio would be without that, for the good and the bad. Like how much of that money. Now, one thing that was really smart, with the state is that, you couldn't get any of that money unless you matched it. And sometimes it was 1-to-1, other times it was 3-to-1. So the state wasn't throwing any money around alone. They were no more than 50% of the money, and in many cases, they were no more than a third of the money. But there was no other private actor. We're not Indiana. Indiana, you've got Lilly just pumping money into their economy. There is no entity like in Eli Lilly in Ohio that from the private sector would do that. So it's really the state that is, and the match. So to me, I guess I would say, in my case, I had to focus a huge amount of attention to make sure that money kept flowing, not just from my organization, but the dozens of other organizations that were our partners. So that's kind of point one. That's kind of pedantic. That's tactical. I would say, really think hard about the systems, the capital flow systems of our economy, national, regional, and try to build, have your strategies better informed by those capital flows, because that's not anything I really spent much time thinking about.
Hmm. Looks like Paul's got one question here. Paul, I'll just read it because we got a minute left here. But
Yeah,
can you
really
speak
quick.
more to community programming, education, planned activities, and basically ecosystem building and how important that is as the capital continues to get deployed?
Well, we're lucky in Ohio that we have these sizable, capable organizations. And, by the way, we're investing as LP in a lot of their funds, whether it's Cincy Tech, Rev1, Jumpstart Ventures, and others. So we're really reliant in partnering with them. We might sponsor it or we might pay for it, but we're not focused. We're focused on maturing the investor network much more than we are the entrepreneurial network. I've spent a lot of time, obviously, in the entrepreneurial network, but that's not where we're focused, at least not in the near term.
Would you say the entrepreneurial network support is critical to the
Oh,
work you're
yeah.
doing right now?
Yeah, absolutely.
Yeah. And that goes to the 600 plus million you think the state's invested in it over the years.
Right.
Yeah.
Granted or loaned in Ohio. A lot of the investing side, it's a loan, but on all the services, it's grants.
Well, thank you, Ray. You've been at this you're one of the OGs in this space now, and you're continuing to pioneer and innovate and drive things forward. Really appreciate you sharing all the lessons learned and the inside scoop on what you're up to. It sounds like a constant. Like a startup. It's a constant work in motion. You guys are adjusting as you go.
Right.
Yeah. Thank you. Congrats.
Thank you. All right. Thanks, guys.
Okay. Thank you, everybody.
Take care.
Thanks, Ray.
Be well.